Welcome, everyone. This is the 10th week of the QuantUniversity Summer School, and I am Sri Krishnamurthy, and I'm very happy to invite you all to the last lecture of the QuantUniversity Summer School series. I live in Boston, and I just got to know that today is the first day of fall in here, so we have just completed an eventful summer. We had a lot of great talks, a lot of good discussions in the last 10 to 12 weeks. And we are capping the summer school with Saeed and Alexander Denev, the authors of the book on alternative data. And I'm very enthusiastic to hear about their amazing research they have been doing over the last many years and how they see alternative data change the world. Before we hand over the stage to them, I want to make a quick couple of remarks about the QuantUniversity Summer School and also for QuantUniversity for people who are not familiar with us. We are based out of Boston, and we started out in 2013 primarily as a machine learning and data science advisory focused on financial services. We've been working with various clients, primarily in a B2B capacity. And in the last few years, we have started creating many educational programs, primarily to bridge the knowledge gap between the amazing research which is happening in the data science machine learning realm and what practitioners need to know. So in that aspect, we have put together the first summer school in 2020, and we basically did 3 courses. One, primary introduction to data science and machine learning using Python. And the second course was an intensive 8-week bootcamp on of machine learning. And the third course was on model risk management for machine learning models. And we have had people from more than 13 different countries come to the summer school. And we also have had 10 plus different lectures from amazing speakers and practitioners. And we are fortunate to have the support of the whole community to make this happen. And we are going to be extending these efforts with a fall school, which is starting in October. We're going to take a week's break next week, and then we'll come back for the fall school. And we are going to repeat some of the courses we have been doing in summer, but also introduce a new course, the FinTech Bootcamp. We call it the 8 Facets of FinTech. And Premier, the risk management organization, has been supporting all these programs, and we are partnered with them to offer these programs. And I welcome you to check out qfallschool.splashthat.com for some of the details on these courses. Without further ado, I want to tell about today's agenda. So we have 2 amazing talks, an introductory talk by Alexander Denev, and then some of the use cases which Saeed will talk about. And then Alexander will talk a little bit about causality in machine learning and AI. And then we will end the session with a fireside chat, a virtual fireside chat with some question answers. So if you have any questions during the presentation, please feel free to use the question answer panel button or the chat window to put your questions, and we will answer as many as we can as time permits. So today we'll be hearing 2 lectures, and both these lectures are primarily sourced from the book of alternative data, which Saeed and Alex have researched and put together. It's a Wiley publication. And for people who don't know Alex leads the AI and data science team at Deloitte. And he has also taken an initiative on responsible AI and various other AI and machine learning initiatives. And he has presented at multiple conferences and various forums. And welcome, Alex, to the QuantUniversity Summer School. Saeed and I were primarily in the MathWorks MATLAB circle probably 10 years ago. And I've known Saeed from his work when he was kind of primarily based out of London and working with another colleague of mine in London. And he's the co-founder of Thalesians, which is a large community organization for various quantitative techniques, and they've been putting some amazing programs. And he's also the founder of QMacro. And he's also one of the well-known researchers in quantitative finance and has presented at multiple forums, and also has an amazing GitHub repository wherein he has open sourced a lot of the packages he has been developing. So welcome, Saeed, and welcome, Alex. And I would like to give a shout out to the book of Alternative Data. It's an amazing book. I've had a chance to take a look at an early edition, and I'm very, very enthusiastic about the book and today's session. So without further ado, I will hand over the stage to Alex.
Thank you, Sri, for your introduction. Please allow me to share my screen.
Give me 1 second. Let me just
sure.
Panelist.
Yeah.
So Alex, you should be able to share the screen now.
Yes, let me try. Yeah, you're able to see?
Yes.
Right. So again, thank you very much, Sri, for having us here. We are an honor to have this lecture with the QuantUniversity. I think everybody is aware of what's alternative data. It's been one of the hot topics and words for the last at least 5 years, together with AI, blockchain, quantum computing, and so on. But how much reality there is behind alternative data? Is there any use and practical applications that can justify this term in the adoption of what's labeled alternative data? This is the question that we try to answer with Saeed when we started writing this book. And it was a very long journey. We started around 2 years ago. And how this book was born out of pure coincidence. I met with Marcos Lopez de Prado when he was finished his book, Financial Machine Learning, and he asked me, why don't you write a book on alternative data? I don't have the bandwidth. I just finished my book on financial machine learning, but there is nothing out there on alternative data as a systematic treatment. And then I approached Saeed, and this is how we started talking. This was approximately 2 years ago, and many things have happened since then. This is really a rapidly evolving field. And we are seeing new platforms being created, new marketplaces, new approaches, and so on. So it's really a rapidly evolving field. We try to push until the last minute to have the most updated version. But what you'll see here in the book, if you buy it and decide to read it, is what happened in the world approximately 9 months ago. But what happened since then? It's something that's very interesting from the point of view of digitalization. We're seeing that due to COVID-19, most of the businesses are becoming digital. The use of alternative data has been increasing, and not only in the financial services sector, but also for the governments. If you want to track COVID, of course, one of the best ways is to use data that's not standard, maybe mobile traffic, satellite images, and different sources that were labeled. They are still labeled alternative. So what happened in the last 6 months actually lifted up the use of alternative data and brought it steadily outside the financial sector. If we stay within the financial sector, of course, there are many uses. We center the book on investment management and trading, but of course we can think of applications in the insurance sector, also in credit markets, credit supply. So this is really a new field. It's emerging, is exponentially growing, and there is a lot of innovation going on in this field. How we define alternative data? It is data less commonly used by market participants, tends to be more expensive, often outside financial markets. It has, in general, shorter history and more challenging to use. Okay, so if any data set ticks one or more of these boxes, we define it as alternative data, but bear in mind what is alternative as today can become mainstream and much more commoditized. In the future, once we have all the necessary platforms and data feeds in place, and once the usage has been widely adopted. So what's alternative? It's a point in time definition. there is a lot of data around the world, and we also define exhaust data as data which is a byproduct of other processes. So most of the businesses, they don't exist because they're creating, generating, distributing data, but they have main activities. And as a side effect of these main activities, they generate exhaust data. This is their digital footprints, and this is the results of their business. If you think of a bank, that can be the number of transactions, the transactions that are being done through the bank. If you think of a newspaper, this is the news article being written and distributed. So the main purpose of many businesses is not to collect and distribute data, but data is a side effect. So how to monetize data? Not to throw it in the rubbish bin, but does this exhaust data have any added value to society? This is what we tried also to answer and examine in the book. Many examples of alternative data sets in the usage, again, focusing on the investment management world. We see different applications, different combinations of data sets. Can be online data, for example, to track prices and hence predict inflation. So if you invest in inflation swap or you have some inflation-linked securities, this is a way to where you can source data. Application credit card, for example, it's another source of alternative data. By monitoring credit card transactions, of course, anonymized, one can have an idea of the status of the economy almost real time. Of course, a lot of examples, social media data, sentiment, to benchmark the sentiment about stocks. So indeed, combinations here of data can be really huge set of combinations. So why do we use alternative data? Mainly for two purposes. One is as a proxy of a variable that we do not observe. So take GDP. GDP is released quarterly in general, but how can we get a picture of the current flow of income in the economy, so current snapshot of GDP, instead of waiting 3 more months for this figure to be published? We can use, for example, PMI indicators. In this sense, these indicators serve as a proxy for GDP. So alternative data can create a lot of proxies before the official variables are published. It can serve also as a complement. So for example, if you want to predict the return on a certain stock on equity, you can use alternative data as a proxy to find what is going to be the next balance sheet. And we show examples in the book from the automotive universe, okay, how to use high frequency data instead of waiting the next financial statement, publication. And we can use alternative data not just as a proxy, as I just mentioned, but something that's complementary to the information that we want to use. In this specific example, we can use production sales data to understand the productions and has the sales of companies, but we can use also sentiment, which is something complementary. So we're not using sentiment to proxy fundamental economic information about the firm, but something additional. You've heard of many V's of big data. There are around 10 V's. We settled for 7 in the book to characterize alternative data. So I put here in the slide big data, but alternative data need not to be big data. Some alternative data sets, they're very small, but there is substantial overlap between alternative data and big data. What is characterized by? Volume, of course, it's increasing. Okay, we see more and more data sets being generated. Variety. So we don't have just numerical data, now we have text, image, video, sound, and so on. So variety, the diversity of the data sources and their nature is increasing. Velocity is increasing, of course, with the speed of the internet increasing, also the velocity with which these data sets are moving increases. Variability, of course, it's increasing as well. This reflects the inconsistency in the data. Okay, and of course, the way you collect the data, sometimes you have physical limitations, and this can create inconsistency in the data, missing data, outliers, and so on. So if you think the most obvious example is satellite images, They can be a very good quality, but of course there are clouds, and you can't really predict those. And if you want to have data points, regular data points, observing, let's say, car counts in shopping malls, you sometimes have long streaks of missing data. So this is something that comes in spades in alternative data world. For example, if you use GPS geolocation data, if you're in between buildings, very close to building, that data is less accurate. And of course, veracity. This again relates to the accuracy, but there is something on the top of that. We all heard about social media. So are really news that we read there real, or they fake news? Okay. Or as another example, this can be too obvious, but if we are buying data from a third-party provider, how sure we are that this is real data, accurate data? It's not synthetic data, it's not fake data. So there is this part aspect as well, which is part also of the risk management of alternative data. I'll mention later. And of course, the value. We're trying to prove in the book that the value is increasing. There is more business value in the data. Saeed later will speak about signals that we found in variety of data sets, and indeed, there are signals in alternative data. If you use common sense to select data sets, you will almost always find signal. Does it mean that this signal is useful? Not at all. Because there are a variety of hurdles that make the adoption of this signal in production costly. This can be a cost of risks, be legal, technological, cyber risk. This can be also the price of the signal. What is the price at which this signal is being sold? And of course, also you have technology cost if you use cloud services for which you pay. So in the end, when you factor in all these costs, you might really notice that the value of the signal is really low. So one must be really wise and experienced too when it comes to building signals and adopting them in production. Who are the buyers of alternative data? Limiting ourselves to the financial services world, of course, we see a variety of factors like sophisticated quants, hedge funds, of course, traditional quants, traditional investors, asset managers, maybe pension funds, and fintechs. These are consumers of alternative data, and of course, they have different needs and purposes why they use alternative data. Okay, what we're seeing now, they're innovators and early adopters. When we wrote the book, we spoke to many market participants. We see some of them really pushing aggressively towards using alternative data. We spoke also to some who qualify as big or medium asset managers. They're experimenting and already have adopted a couple of alternative data signals in production. And of course, we see laggards, people who heard alternative data, and we even spoke to asset managers who haven't ever heard about alternative data. So the spectrum is quite wide, as you see here. And what we think that firms that are reluctant to embrace these new approaches coming from alternative data will face a strategic extinction risk, because we see value in alternative data, and we try to prove this in the book. So when we were writing the book, we extracted some statistics about the growing use and the total spend on alternative data. You can see it here. And it's already outdated. As I mentioned at the beginning of the talk, due to COVID-19, the consumption of alternative data has increased. So at the moment of publication, we live in such fast evolving world, this figure might appear is too conservative. How do we embark on the alternative data journey? Of course, depends which one of these players you are. What is your size? What is your maturity? What is your risk appetite for innovation? So there are many dimensions to be considered here. But if you want, of course, to do it yourself, to venture on this alternative data journey, you have to have talent. Okay, so you have to have data scientists, and data scientists are costly. So we give here an example. If you want to set up a data team, you need head of data, data scientists, of course, one data engineer, one data scout, and 3 data analysts. New York prices, this is around running costs of 1-2 million per year. Of course, if you're a big asset manager, this is a small cost. If you're a family shop or a smaller fund, of course, you cannot afford to hire this team. And then, of course, there are other options. Many data vendors, they already provide signal as a service, so you can opt to buy the signal directly from the data vendor. I mentioned data scout here, and data scout is a new profession that we see in the market. This is a person who is specialized in understanding the data landscape out there. Who are the data vendors? What data sets are available? Which one are of good quality? Which one can be relevant for the asset classes for that particular asset manager? Which one are rare? Which one are overcrowded already? As many market participants could have already bought them and used them in production. So data scout is, we think it's an important profession, and of course, as there are many more data, each and every day there are so many data sets appearing. So this person really needs to be up to date. What's happening in the data landscape and also in the platforms that are being used in this space. So this is a survey that we performed to 110 market players. It's already outdated. It was late 2018. We're seeing a shift, as I mentioned. So we don't present this survey in the book, but it's interesting to show what the market saw 2 years ago on a sample, which is quite significant. Look at the top right part of the screen. So what's your organization status for utilizing alternative data? We see that around 20% are doing some experiments or are using alternative data. So 1/5. Here in this sample, we had different respondents, like large firms, very large firms, medium-sized shops. And of course, 2 years ago, 20% were using alternative data. 50% were considering, so they had heard what alternative data is, thinking about whether to use it, thinking about a vision. So these figures now look more optimistic. So we see, as I mentioned before, more and more funds are shifting towards 21% you find at the bottom. And there are lots of POCs, proof of concepts, being run by investment firms. So this is rapidly evolving. How is data delivered? We're seeing different options in the market. This on the data vendor side. If you want to sell data, of course, you need to deliver it. There are several options, and these options could take different market needs. As I mentioned before, less sophisticated market players could opt for something that's already distilled as a signal instead of buying raw data sets. And data vendors are trying to accommodate the different data consumers. Of course, as a first pillar, we see data as a service. State of art, it's data lakes via single point of access. We show some examples in the box at the bottom. Infrastructure platform as a service. This involves collocated cloud infrastructure, maybe tech racks already available at the premises of the client, where data can be directly sourced. We see other configurations like analytics as a service, where data science workbenches are already collocated with where the data is, where data scientists can directly plug in, explore the data, do some backtesting. Managed analytics as a service. This is relatively less mature, but this is when the signal extraction is outsourced to a company which has data scientists. And this is for smaller shops, and many data vendors are considering jumping into that space. And of course, we have something more standardized. This is a signal as a service. as I mentioned before, you can think of a pile of hierarchy of how these things work. So we have raw raw data is the first part of this pile. Then we have clean data, so where the outliers are removed, missing data is filled, but many sophisticated players, as hedge funds, they want just the raw data, because removing outliers by the data vendor could mean removing some precious signals they want to exploit. So the third part of this pile is the signal as a service. So already trading patterns and factors extracted and delivered by the data vendor to the market players. And the fourth part of this pile is smart indices. How to combine the different factors coming from alternative data into a smart beta strategy. We consider 8 steps in how alternative data is adopted. It's adopted by asset managers. 8 steps. So the first one is, of course, to set up the strategy, the vision. Okay, shall we venture into alternative data world? So this is a question, and this is a question for the CIO, for the CEO, so the decision makers who run the business. Shall we start using this type of data? Of course, with the help of the CDO and different portfolio managers, but this is high-level management decision. Of course, second one is data requirements. Identify the relevant data sets. This is where the profession of data scout is very precious, and you save a lot of time if you have good data scout. Then acquisition, due diligence, third-party risk assessment of the data vendor, get some samples, understand, play with the data, doing some small POCs. Risk assessment, evaluate all the risks, and there are many risks, of course, but they can be managed quite successfully. We have financial operations, operational regulatory risk, reputation, and so on. I'll spend some time on this later. Of course, implement controls to manage these risks, incorporate the signals into a model, and of course, we have the decision making and the monitoring. This is the value chain of alternative data in the asset manager, and of course, this value chain must be managed. So what are the risks? I mentioned already. Data provenance risks. Okay, is data legally obtained? Are they scraping a website, and are these data vendors allowed to do that? Okay, does it contain information that's not been anonymized? So breaking GDPR, for example, if we deal with credit card transaction data. Or sometimes data might not be explicit, but you can always, it's certain data sets, you can reverse engineer the name of the people by combining, of course, with other data. So one must be really careful and perform due diligence at this point. Material non-public information risk. Does this data set contain any private non-public information which can be classified as insider trading information? And of course, mentioned before, third-party risk. Is this vendor reliable? Is it a big renowned organization, or this is a small startup? Of course, there is third-party risk that the data was not generated accurately, can be even synthetic fake data. And of course, third-party connected to the disappearance. We've seen some startups sending alternative data disappearing. Do they have the financial side, enough funding for them to continue this business, or they're at risk of disappearance? Of course, talent risk, mentioned before, it's important. It's a fight for talent in the data science world. Data scientists are expensive. The turnover is very high. There is, of course, risk connected to this. Always model risk. Alternative data tends to be more unstructured. Okay, text data, audio, satellite images. There is, of course, the stage of feature extraction, which is the factors, finding the appropriate factors. And of course, everything is more complicated. So you use AI models, for example, to count the number of cars. You can use convolutional neural networks. Then you extract these factors, then combine with sentiment factors, put them together in another model that can be nonlinear. So model risk increases in alternative data world. And of course, with any AI model, you can have problems connected with interpretability and transparency, are very bad when you have to explain this to let's say, to the board level of your organization. I want to spend a few words before I pass to the floor to Saeed. How do you purchase data? What is the price if you're a buyer of data? What's the price that you should be paying for the data sets? And if you're the data vendor, what's the best strategy to monetize your data? This is unanswered by the industry as of today. We are seeing many attempts to create data markets. Not all of them, I would say most of them, are not efficient at all, which means that what is missing, the fundamental thing that makes markets work is pricing. And pricing, it's not always done in an optimal way. Sometimes it's done ad hoc way. According to the size of the clients, data sets are priced in a different way, in tiers. Sometimes data is oversold, so we see overcrowding. So when a data set is used by virtually all the market participants, alpha could disappear. So what is the right pricing when you sell to more people? Okay, so this is a question to answer. We examined several options in the book. Of course, data is non-depletable asset, so you can create infinite amounts of copies and sell them. So classical considerations like supply and demand do not really apply. We consider several options of how to price data. Of course, tier pricing is one option. But we venture and we even consider data auctions as a way to extract the maximum value from data vendor point of view, and we even give some pointers of how to organize these auctions. So alternative data is just to conclude, is a new field. It's rapidly evolving. There are signals. There are definitely signals. Almost wherever you look, of course, if you look wisely and you have good enough talent really to understand those data sets. But discovering a signal is not a sufficient condition for them to be useful. What you have to take into account is also the processes, how you extract this data. Okay, you have to take into account the pricing. Are you offering the fair price from your point of view for that data set? Also the technology. Do you have the technology to cope up with a large volume and high frequency of alternative data? So there are a variety of things that needs to be considered when venturing into an alternative data world. But if they're done properly, we believe there is good amount of alpha out there, and we're witnessing already many players going that way quite successfully. With this, I would like to call in Saeed to replace me for the second part of this session, and Saeed will show you some signals that we found in data.
I was going to say I probably can't replace you, Alexander. You're irreplaceable. So,
right.
But I'll do my best. I'll do my best.
Cool. So give me 1 second. Let me just.
Sure.
I think I have to do a magic trick in here so that I can reclaim privileges, and then I can give you the privileges side.
Sounds good.
Okay.
So I'm going to do my part of the presentation, and then at the end we'll flip back to Alex for his bit on causality.
Yeah. Thank you, Alex, for the amazing introduction. That was really, the 60,000 foot view, but I really wanted to see each piece in depth. So, I remember my first flight, when I was kind of going through the landscapes of Central Asia and Europe and every place. Like, why can't the flight just stay there and like spend another half an hour so I can get the whole 360-degree perspective? So maybe we should kind of set up like a full day session so that you can go deep into each V's and each segment and talk more about it. So Saeed, you are now the presenter.
Okay.
Whenever you're ready.
Let me try and see which screen I can. Okay, can you see my screen on a PowerPoint?
It's starting to. Yes, I can see your desktop and I can see your PowerPoint and the Zoom window behind it.
Okay, great. All right, so I'm going to try and continue on from Alex's part of the presentation. So as was mentioned, I'm going to talk about kind of specific signals that we've found and very specific use cases as well. So this is just a summary of some of the use cases from within the book, but hopefully it will give you a good flavor of some of the types of things that you can do with alternative data. I would stress that this is not an exhaustive list. So it's only a couple of things that we've specifically looked at in the book. So the first case study that I'd like to discuss is looking at Federal Reserve communications. So this is an index that my firm QMacro has generated. It's obviously not a secret the Federal Reserve communicates regularly with markets. So it could be through the course of doing speeches, statements, minutes, also in recent years, press conferences following the FOMC decision as well. And markets react to this. They don't purely react just to policy changes, although that's obviously probably the largest reaction function, but also in terms of what the Fed says in terms of understanding concepts like forward guidance and so on and so forth. What I've done is essentially done a lot of work essentially to read all these communications, which are publicly available from the web. And I've spent time basically creating a data set of these Fed communications. It's not exhaustive, so there might be certain data sets which are beyond a paywall. Obviously, we don't have license to look at that, but for publicly available data, speeches, etc., we do have a look at that. And it's actually a good point that a lot of the work that you might end up doing with alternative data involves this cleaning step. So getting access to the data, cleaning, etc. So and it's exactly the same with this instance. I probably spend more time doing the scraping of the data and the cleaning, getting it into a reasonable shape compared to other parts of the process. So once the data set is relatively clean, I've got around, I think, 25 years of Fed communications in the data set. Then I applied some natural language processing to the various texts, essentially trying to understand what the sentiment is. So looking at positive versus negative sentiment and coming up with a score based upon that. The rationale being that when the FOMC are more upbeat and they're more positive in their tone, typically that means that interest rates are likely to rise, or at least yields are likely to rise because it's a kind of more hawkish outcome. But this compares to the outcome where they're a bit more downbeat and negative, and that kind of is associated with more dovish rhetoric essentially from the Fed, and that you'd expect there to be a decline in yields. So essentially, I've from all these sentiment scores of all these individual texts within the data set, I've then constructed an index which gives you an overall view on Fed sentiment. Essentially, how positive or negative are the Fed in terms of their messaging process. Obviously, if you're like an economist and it's your full-time job to read and follow what the Fed is doing, you'll probably read all of these as it is. But I would conjecture that most people within the market probably don't read every single thing the Fed, or at least not a large body of what the Fed is doing. So the idea here is that we can use the mechanics of natural language processing, etc., to decipher this alternative data set, which typically I'd say most people don't take enough time to read in practice. So here we look at the relationship between these. So this is actually a slightly older version of the data set. So I've got a slightly newer version here. If I go to my website, basically, so we can have a look here. So this is a slightly different construction here. So it's the peaks and the troughs are not exactly in the same place, but what I've done is I've plotted that against changes in the US 10-year Treasury yield over the past few weeks. And we can see for the most part, they do tend to follow each other. Admittedly, it's not a perfect fit, but actually if you regress them, you will find the T statistic is significant. And there are notable places where there's divergences. So in particular, for example, when Trump got elected, there's this massive divergence here in between what the Fed is saying in red in terms of the sentiment versus what was happening to yields here in blue. And the rationale is basically that the driver for US Treasury yields was not really what the Fed was saying necessarily, but it was more in terms of the whole reflation theme with Donald Trump getting elected. And here, just to give you a bit of flavor of the data set here, we can see some of the recent communications here, some of the scores associated with them. So I don't have, for example, things behind firewalls or video interviews, but other things like the press conference, etc. I do have that within that. So that's one example of kind of an alternative data. I wouldn't necessarily call it a big data set. So even 25 years of Fed communications probably amounts to, I don't know, 10, 15 megabytes in terms of files. But we use some of the techniques associated with structuring data sets like natural language processing, which come up a lot in alternative data. The next discussion that I'd like to look at in terms of case studies is looking at flow data for FX and basically creating trading strategies to decipher the signal. So essentially, if we think of FX as a more fragmented asset class compared to other markets like equities, quite a lot of FX is actually over the counter. It's not actually exchange traded. There is some trade on exchanges like CME, but it's not. I would say it's a relatively small percentage, essentially. You have many different trading venues, and also a lot of it might be bilateral trading. For example, I'm a hedge fund and I trade with Citi or Deutsche, etc. And a large part of the trading is done that way. So essentially, it can be difficult to find comprehensive volume and also flow data in FX because it tends to be associated with many different venues and places. So CLS is essentially a company which settle most of the over-the-counter deliverable FX trades in the market. So if you're talking about something like euro-dollar, their coverage is essentially over 50% of the market. This compares to, say, with individual liquidity providers that I don't think any of them will actually be able to claim 50% of the market in practice. And essentially, they collect and distribute this data, and they have hourly FX volume data, and also flow data, which they've categorized for various price takers, such as funds. So what I've done is I've taken the data set associated with funds and looked at the FX flow based upon that from the guys at the CLS. And the rationale is this tends to be relatively directional when we look at specifically the fund subsector. And the actual flows actually tend to be quite correlated with spot as well, if we look historically, in a way that, for example, corporate flows are not necessary. Corporate flows tend to be more contrarian. And what I've done is I've created a pretty simple Z-score based upon this FX flow data for funds. And essentially, when funds are heavily buying a certain currency pair, we end up being long that currency pair. And conversely, when they're very short, we end up being short as well. So we basically follow what funds are doing. And you can see here, I've just got this Z-score that I've constructed. I've got the upper Z-score at 1 as a trigger, and then the lower Z-score at -1. So relatively simple trading rule that I've got there associated with this data set. And what I've done is I've created some trading baskets associated with this flow data set using that specific trading rule. And I've looked at the main deliverable pairs in developed markets, such as euro, dollar, dollar yen, and so on. And I've compared that also with a simple trend following strategy, essentially to act as a benchmark. And what we find is that if we compare a strategy which looks at daily flow data versus trend, if we combine them together into one strategy here, the gray strategy, the information ratio is actually higher than trend in isolation or daily flow in isolation. So it's suggesting that if we're already trading markets in FX using trend, it's likely that we'd actually improve our risk-adjusted return by including daily flow data. So there's something in daily flow data which is not necessarily present by looking at a pure trend following strategy. So it could potentially help diversify our strategy. And if we also include, in addition to the daily flow data, we look at an hourly trading rule using hourly flow data, we have an even higher risk-adjusted return as well of 0.92. So what it suggests is there's value by looking at this flow data high frequency, essentially. And this, I would say, this type of data you would consider as alternative data because it doesn't tend to be very prevalent within FX. Maybe in a couple of years, we'll no longer call this alternative data within FX, but I would say at this point in time, this type of data would be considered a bit unusual, I would say, compared to other data sets. So this is the in sample, and here we have the, an out of sample period as well. And we can see here actually trend underperforms the most, whilst the others are kind of close to flat. So trend can kind of be our benchmark here. So another case study that I'd like to look at, this is something totally different, no FX or macro essentially, is looking at satellite data to estimate earnings per share. So it's well known that satellite data can be used to help forecast the earning per share for retail stocks. And in particular, you always hear the classic example, if you've looked at this type of thing, in terms of Walmart. It's been used extensively in US markets for US retailers such as Walmart. And I think there's a firm, Orbital Insight, which actually looks at a lot of US satellite data. And there's many others out there as well. But I would say it's not really used as much for European firms as yet. So it's not that the technology doesn't exist. Obviously satellites go over Europe as well as US, but it often tends to be the case that data sets tend to come about in the US, and then the ideas spread elsewhere, essentially. So here it's just replicating that idea, but for European retailers. So essentially, Geospatial Insight, they get access to a lot of satellite data, specifically over the car parks of various European retailers. And the idea being is that we use the car counts as a proxy for retail activity. And the interesting point I would say with this type of, not just necessarily this specific data, but one thing that you can do with satellite data is that potentially you might be able to map companies where you don't have much data at all. So particularly private companies that are not really forced to release much in the way of activity data. So this type of thing can help you proxy those companies which are privately owned. And this is of particular relevance for firms such as PE investors. So this covers a number of European retailers, people like Tesco, Carrefour, etc. And as mentioned, it covers both publicly traded and also private companies as well. So here I've done something, essentially created a car count score. So what this does is very simply, I look at the total number of cars that have been counted in the data set, and typically they will end up basically taking images of various car parks throughout the month. Obviously, a lot of work goes into identifying in the satellite images those areas of interest. So they need to map out, like do polygons essentially to identify where those car parks are. So I've essentially looked at a 6-month window, counted all the cars, and then you have to normalize it by the surface area of the car parks that have been photographed. One issue is obviously if we don't look at the surface area of the car parks, we don't know how full they are. So just looking at the car count in isolation is not going to be as valuable as looking at the car count divided by the surface area of the car park to identify how full it is. So that's the crucial point. If you don't look at the surface area, I don't think you'll probably get as good results. So that's my tip for looking at satellite data when you're looking at car counts. Make sure you look at the surface area as well. And then I've made sure that those 6 months are coincident with the 6 months earnings period. In this case, for the European retailer Marks and Spencer's in this example. So our period for the car counts will cover the same period as the official earnings released by this company. And I've plotted this car count score in gray here. And against that, I've plotted the earnings per share in blue, which has been released basically on the earnings day. And against that, I've also given the Bloomberg consensus as well of sell-side analysts. Obviously, the nice thing with the car count is that's available as soon as the earnings per share period is finished. Whilst if we look at the official data, that's only available once we have the actual earnings release date, and that could be several weeks afterwards. So essentially, the car count could give you a much fresher estimate on what's going on versus having to wait for the official release. And here I've just presented, obviously, Marks and Spencer's. And we can see actually just this simple plot of car counts divided by the surface area actually ends up being, it tracks it fairly well. Obviously, in this instance, the car count measure didn't really cover it that well. But say here, the car count measure actually was pretty coincident with the actual earnings per share and did a lot better than the consensus estimates in this instance. Yeah. So if we go on a bit further, let's go on to the next page. So this is just one company. So admittedly, we can find that. Sorry, I just got a bit of that background noise. So what we can find here in this specific instance is that just a relatively simple technique can end up being, like I would say, fairly nice proxy for what the earnings per share for a company would be. One thing I would stress is in practice, you wouldn't use one specific variable for the earnings per share, like car counts. You use this as an additional factor to look at in terms of augmenting into your model. And that's the crucial point, I would say, with alternative data in general. It's not about replacing your models, it's about augmenting them with new variables, essentially. Now we look at something slightly different. So in those cases, we're looking at generating alpha, coming up with better estimates, coming up with trading rules, etc. But the flip side of that is if you're executing, you want to be able to save alpha, essentially, reduce your trading costs. So one way to do that is through transaction cost analysis. So here, essentially, what my point is that big data, and I say alternative data, isn't just for generating alpha. It's also about saving money as well at the same time to reduce your transaction costs. So you want to understand how much is each liquidity provider charging. Is one algo better than the other? And in order to do that, you need a lot of data. So some of that data is your own trade data, but it can also include, it obviously needs some sort of benchmark as well for you to look at. And this is essentially something related to tick data. And tick data, I think potentially you might be able to think of it alternative data. There are differing views, obviously, on that. But I would say tick data is probably not as commonly used as daily data, I would say. And what I'd like to do is just give you a very simple example of how to do transaction cost analysis. So this is for my TCA Pi library, and this is all open source. So you can play around this with GitHub and do whatever you want. So if you like doing Python. So let me just go onto Chrome. So the first thing that I would like to show is just the GitHub page if you want to download it. So it's on github.com qmacro/TCA-Pi. And then if you want to have an interactive view on it using Binder, you can click on this. This will launch Binder. I've already done this earlier, so it takes a couple of minutes to load up because I'm using a free public server on Binder. Then we can click here a 10-minute view of TCA-Pi, and then it will basically load up. Okay, it didn't work because I didn't start Binder soon enough. But essentially, it comes up with a Jupyter notebook typically, and you can work through it, the example. So I'm not going to do that now because it'll probably take 5-10 minutes for it to kick off the server. But if you want to do it, you just click here, Launch Binder, and go through and click on the Jupyter notebook, and then you can interactively run the cells. What I can do is to go through the GUI. So this is no code, unfortunately, but you can set this up if you run it. So this is running basically on Linux in the background. What we can do is we can essentially select our trading period. So here we've selected it from 2017 November till the date in December. We're looking at all the trades that we've executed for Eurodollar. So this will basically now run in the background for us. So it took 4 seconds there. It'll plot all of our trades. So essentially we see our orders against the actual tick data. We can zoom in here. We can see all our buy orders. We can click on them. We can look at the price before. We can look at the price after. We can also look at the slippage as well. So the slippage is the difference between where we executed versus our mid-market benchmark. And our mid-market benchmark, remember, is some source of tick data. We can also look at execution level as well. So you can zoom in here as well. So the difference between orders and executions is that orders have a start time and an end time, but there can be multiple executions under an order. We can zoom in again, and we can click on it, and we can look at the execution. And this is all open source, and you can play with it. So if you're interested in the technology, I've used Dash actually to do the GUI, and I've got like lots of funky things in the background to distribute the computation, such as celery. So even if you're not into execution and that type of thing, just to have a look at the codes to understand how I've put together this might end up being of interest anyway. And just whilst we're here, I've also got another library as well, FinMarketPy. So that's pretty popular on GitHub, and this is for backtesting trading strategies. So you could potentially, if you have alternative data set, use this as a way of generating a signal to backtest a trading strategy. And there are examples of a trend following strategy there. I'm just going to open up very quickly just to see if there's any questions on the chat. Okay. So that's an example of transaction cost analysis. So the flip side of trying to save alpha with kind of unusual data. In this case, I would call that tick data as my unusual data set in this instance. Okay, let me go back here. So this is just walking through what I was just showing you now, but that was kind of an interactive way. Okay, so here just plotting the trades and the orders. This is kind of some other functionality as well that you've got. So you can look at a large body of trades to understand how the transaction cost changed over time as well. So this is additional functionality that it has. Again, this is looking at trades over a long period of time to understand our relative transaction costs. And this is looking at the distribution of the slippage. So now we move back into kind of generating alpha using alternative data. So here we look at Bloomberg news to trade FX spot. So first of all, let's discuss the difference between unstructured and structured news data. So if we think of unstructured news data, this is essentially requires us to read our news articles, blogs in their raw form, do the web scraping ourselves, do a lot of the cleaning. So it's kind of similar to what I was doing with Fed Communications earlier. It tends to be a bit time consuming, and particularly when you're looking at lots of websites, it might end up being a very large amount of data processing for you to do. And also you need to do a bit of NLP work as well. Although typically these days there are a lot of natural language processing libraries in Python that help us essentially to run stuff. So we don't need to implement NLP engines directly ourselves. If we do look at the flip side of that is structured news data. So here vendors essentially process a large amount of news from numerous sources, and they basically structure it into a form that's readily accessible. So typically they might put newspaper articles into XML format, and they'll be tagged already for us with lots of additional metadata that can give us information about them. So for example, if it's news data, tagging the ticker, the assets associated with, also the topics as well at the same time. So the idea here is that traders can concentrate on creating trading rules as opposed to doing the cleaning of the data. There's pros and cons of both, obviously. So I'm not going to say one is always better than the other, but I'd say it's probably simpler to start with a structured news data set. And then if you want later on, maybe to start creating your own data sets, that's probably what I would recommend in practice. I guess the idea of trading markets using news is not a new idea. Traders have been doing this for many, many years. But the point is we want to be able to automate this in a way that we can basically read as much news as we want. Because a human is obviously restricted in terms of how much news they actually read in one specific day. And then there's all sorts of questions associated with, like, how do we create our trading rule? What's our buy? What's our sell? What news do we look at? So there's lots of questions that we need to answer before we actually get to our trade. So the general approach, I'd say, to news filtering is we've got several approaches. So one is to pick words and sectors which are relatively generic, things like job cuts, essentially. But I guess the picking depends upon our data source. But we've got to be careful we don't use hindsight bias. So we know, for example, here in this plot, I've got the number of number of articles associated with the Greek debt crisis on Bloomberg News. Obviously, once the Greek debt crisis has happened, we know it's an important driver of markets, but we won't necessarily know that beforehand. So we need to be careful when it comes to more generic rules. So this is essentially some of the specific steps that you might use for working with text data sets: the raw data collection, cleaning the data set, structuring it, filtering it for the news that's most relevant for our assets, creating an indicator as well, and then lastly, creating a trading rule too. So I'm going to use a Bloomberg news dataset. There are many other datasets out there from firms like Refinitiv, Ravenpack, etc. So you've got a choice of several to look at. It's a structured dataset, and given it's written all by journalists, it tends to be a bit easier to process because it's in a consistent style. And each of the articles has tags that will be very useful, like the timestamp, the title of the news article, what's been written. As I was saying earlier, things like the tickers, also the topics associated with them as well. So I'm going to generate some news signals for FX. So I'm going to look at tickers such as euro dollar, sterling, Aussie, Kiwi dollar, etc. And look at news associated with that, and then look at the sentiment of the news on that. Later on, I'll also look at topics associated with the Fed and ECB as well. We also need to do a few additional steps like cleaning the body text slightly. We need to apply sentiment analysis for each article to get a sentiment score. And then we aggregate these into daily observations and then Z-scores from which we create our trading strategy rule. So in this case, I've got here the dollar-yen score. So the dollar-yen score is the scoring of all the dollar articles minus all the yen articles. And it's basically just looking at short-term momentum in that news. So when it's above the line, it means it's positive in the short term. We buy dollar-yen. When it's negative, we sell dollar-yen. So trying to keep things relatively simple. Just piggybacking on short-term momentum in the news and using that as a way to trade the currency pair. And then here I've got the risk-adjusted returns for that. I've got here the news-based rule in blue versus a simple trend-following strategy. And we see that my news-based rule actually outperforms trend-following in this sample pretty significantly. But also there's not much correlation between news and trend. So just like with our flows trading strategy earlier, if we have trend, adding news to it is probably going to improve our risk-adjusted returns because we're not extracting the precise same data. And here we create a basket as well using the same trading rule. And it's kind of more obvious here that the news-based strategy outperforms trend. We find that trend actually does okay in recent years, but obviously before that it didn't do well at all. So whilst the news strategy has actually done relatively well throughout the sample by contrast. We can also look at news volume as well. So the number of articles we have on an asset, we find is actually quite correlated to volatility, which makes sense. If a lot is happening in a certain asset, it's likely that journalists will write about it. So there's going to be a high correlation between the news written on that asset and the implied volatility of it as well. And very, very quickly at the end, also basically we look at scheduled events. We try and predict the volatility around Fed meetings and ECB meetings dependent upon news associated with Fed and ECB meetings, essentially. Here what I've done is I've plotted the implied volatility on FOMC days, the realized volatility, the difference between implied and realized. I've done that as well for ECB. So this is just the overnight points. And we find that typically implied tends to be higher on those days. So typically you'd probably make money selling vol, although obviously there's a risk it might blow up. But the key point here is we want to understand if we're looking at the news volume written on the Fed before the Fed decision and also the news volume written on the ECB before the ECB decision, is there some sort of relationship with the volatility on that day? And we find actually if we plot them, actually the lines follow each other relatively well. And this seems intuitive. So if everyone is talking about a Fed meeting, it's likely that vol will be bid up on that day. Conversely, if there's not much market discussion around it, then vol tends to be relatively low. So potentially if you're trying to trade vol around these dates, looking at news volume as an alternative data set variable in your vol forecasting model could actually be quite useful. Okay, I'll just skip to the end here. So that's the end of my part. So basically, just looking at use cases, just a subset of different use cases. I've just got a quick question here. Basically, saying use back testing when you have rare data events, rare data points. I think it can be somewhat challenging because let's say, for example, Brexit, you've only got one data point. Potentially you can look at the Scottish referendum. But I would still say looking at that one or two data points is probably better than nothing. The cases that I've looked here for FOMC and ECB are somewhat easier because those events are repeated many times over the year. So if you end up looking at a 10 or 15 year sample, you will actually get a reasonable number of points. Yeah, I would say there's not really, I think it's pretty challenging when you're looking at rare events, but potentially adding an alternative data set could give you more insights over them. But if you only have one data point, that you only got one precedent, but it's still worth investigating that. So that's just replying to Andreas's question. And I'll stop and let Alexander finish on causality.
Yeah, thank you, Saeed.
So Alex, I'll hand over the baton to you. We are already at like 12:50. Maybe you could take maybe 5 minutes to.
Yeah, not more than that. Yeah.
Perfect.
If I can share my screen.
Yes, let me do that.
This relates very much to the previous question. So, of course, we need repetitions of the event to have something that can be back tested in a statistical way, and some events are recurrent, depends on the level of abstraction at which you look at them. So if you look like relation between GDP and returns, so we've seen many declines of GDP over the last 100 years, of course, because of different causes. And if you want to really test granular, backtest granular unique events, this is more tricky, of course, and you cannot apply standard statistical approaches. This leads me to the last 3 slides of the presentation today. This recent blog Saeed and I published. It's just a blog on LinkedIn, so we didn't have time to create a fully fledged article. But the idea here is simple. So we took some news streams. Oil news streams, Brexit and COVID. These are different news streams we took from Bloomberg, and of course some of these are exogenous. We here train the probabilistic graphical model or Bayesian network or causal network, different names, and we train automatically on the different news streams. So we have 2 asset classes essentially: FTSE implied vol and returns on FTSE, and you assume that you're an asset manager investing in these 2 asset classes. So we train automatically this model on data in the period 1st of September 2017, end of October 2017. And of course, COVID was not on the radar. Okay, oil news stream changes at that time. Oil markets were quite calm, but we all know that Brexit was on the radar, and every bit of news on Brexit caused movements in the implied votes and in return. So what the machine found is the correct predictor variables, a variable in this case Brexit, and it linked causal link to implied vote changes and returns. You see, these are alternative data sources. So this is text. These are alternative data sources that we form exogenous variables. From them, of course, there is a link between Brexit and FTSE returns and implied vol, as well, of course, COVID that was not on the radar, but we'll see. This is the situation in the period 1st of January this year, 1st of March. We see there is absolutely no link between oil, Brexit, and COVID, and there is no link from these exogenous variables to the return of the 2 asset classes, which nevertheless remain correlated, as you can see. From the arrow linking these events. Again, this is automatic training. You can see the equations there that are encoded by this probabilistic graphical model. But again, these were automatically obtained through the PC algorithm in probabilistic graphical models. But what happened in the last 6 months, it's not a big secret. So we have the COVID-19 news stream picking up. And in the period 1st of March, 1st of May 2020, we also had some turbulence in the oil markets, while Brexit fell off the radar for that period of time was irrelevant. So you see the machine here correctly gets the statistical relationship, not guess, but learn the statistical relationship between different events. Again, Brexit is a unique event, but news on Brexit, they're repeatable, and they can influence, of course, the asset classes you're investing on. So here, the art, and also to the profession, the data scout, I mentioned before, the art is to understand what is the market theme of the moment, what are the relevant news sources that you have to switch on, really to detect what's impacting the asset classes of interest. You can, and I think alternative data is a good opportunity. I did before, many years before, writing on causality on Bayesian networks, how to create scenarios through Bayesian networks for events that never happened in the past, like Brexit, breakup of the euro, and so on. I think that topic quite nice marries with the alternative data topic, because most of the variables that you want to use in the scenario are not financial variables. They can be geopolitical variables, can be, as you see, public health variables, like COVID-19. Now we live in an information-rich world where data about these variables that you might want to position in a scenario is available almost everywhere. Yeah, I think we're running over time. We have very few minutes for Q&A.
Thank you so much, Alex. Thank you so much, Saeed. We will just switch back to one thing, and then I will revert back to Q&A. Give me 1 second.
So we have questions on the chat, not in the Q&A chat, in the other chat.
Yeah,
we
so
have
I have a couple of questions. So the first question is, which top key alternative data principles do you recommend for analysis outside of fintech? It's a generic question. Any thoughts?
Yeah, it's in terms of principles such as like legal principles, or I guess it depends how you interpret the question, I suppose.
Yeah, I don't know how to interpret this question.
Yeah, one thing I would say is that
I would say, for whoever asked the question, if you could clarify a little more, I think that'll build a little more context.
Yeah. Well, one thing I'd say, what is the principle of using alternative data in any case, whether it's in trading or say risk management or credit, is you want the alternative data set to tell you something that your existing data doesn't tell you. Because if your alternative data is simply basically telling you exactly what you already know by existing variables, it's not of any value. So the key point is, does it tell you additional information that you don't already know? So does it increase your R square essentially? Is it uncorrelated? So I know it's probably a bit of a cop-out answer, but that's essentially the principle that I would use. So the alternative data set needs to tell you something additional that you didn't already know from your existing data sets.
Right. And I think there was another question. What was the R square on the last slide of the FTSE returns?
You can work it out from the stochastic errors there. I don't recall it, but if you take the square root, you'll get it. Don't let me do this now real time. But you see in the equations, the normal, the Gaussian error, you have the variance there.
And I've also shared the slides on the Q Academy site. All the slides I've just put in the same slide deck. So you can download or you can just view it on the platform. It has both Saeed's and Alex's slides. And I've also embedded the video which we are currently live streaming, which is on YouTube, also in that. So if you want to go and revisit the slides, I know the last few minutes, I had to rush you a little bit, Alex, so that's fine. I think there's another question. Any examples on what practitioners are doing wrong with alternative data and attempt to use of alternative data going wrong? Any similar to the algo trading mishaps? Anyone? Any stories? Any war stories on mishaps of using alternative data?
I think the key point with alternative data, I'd say this is data science teams more broadly in funds, is they need to be an integral part of the investment process. So they can't just be set, like a data science team can't be just sent away and say, look, find something in the data and come back to us. And I think this probably has happened with certain funds. essentially. So they end up being an independent unit, and then there's not really much communication between the two. The key point with alternative data, you want to ask a question first. So we want to know, like, what are retail sales going to be like? Are, for example, Starbucks selling more Frappuccino than, I don't know, than coffee or latte or something like that? So there needs to be questions that need to be asked to begin with, and then you go and search the alternative data. Then the data scientists can basically go away and try and answer those questions. This is talking from the viewpoint of a discretionary fund. But if they end up being used in isolation, then there's not really any way to monetize what happens. And I'll just say generally, if you don't have any questions to begin with, and you'll just end up finding spurious correlations with the data. And this is obviously not just an alternative data issue. It's something which is related to any sort of data set. So you need to ask a question essentially to prune your search space to begin with, and then you can work on it. Particularly in finance, because the signal to noise ratio is so low. So it's something that afflicts finance in particular.
And I kind of also want to just add that, a lot of use cases in the alternative data segment, it's actually being useful to the fundamental analysts quite a bit, especially for people who have these kinds of questions like you were mentioning, Saeed, in terms of asking the question and not having the data and just coming up with numbers. Now you have the actual data sets you can use to come up with those insights and then potentially lead to, having those decisions rather than just going by, assumptions and proxies, right? Cool. So I think it's 1 o'clock. It's time to wrap up. I thank you again, Saeed and Alex. I wish we had a little more time to, get to some of the questions I had, but I'll probably, schedule something offline with you to have those questions. And again, Saeed, thank you so much for sharing all the code and the GitHub links. And I will update the page so that people can easily find your GitHub page. And also, as we discussed, we will see if we can make some of those able to run through the Q sandbox so that they don't have to install anything. And this is something I want to end this summer school with. I know it took quite a bit of effort from all the speakers and also people from my team. Many of them you don't see, but have been working tirelessly behind the scenes to put together all the content, the links, the sandbox related aspects. So I thank all of you for putting together all this hard work and putting together all these amazing presentations and your time to share it with the world. And I also thank all the community members who have been coming back week after week to listen to these lectures and upskilling themselves. We're living in interesting times, but that hasn't deterred you from continuing your journey of learning. And I hope the last 10 to 12 weeks of effort of we putting together these kinds of workshops were helpful in your learning process. And I welcome you back in fall when we're going to have many more speakers on various themes. And our marketing team has put together this nice video. So I'm going to share it with you. It's basically an acknowledgement of all the support we have gotten from the community and all the speakers. So I'll play it with you before we end today's session. That's all for summer 2020, folks. I hope you have a better summer 2021, and I will join you again in the fall. Thank you again. Thank you, Alex. Thank you, Saeed. Bye-bye.
Thanks for coming. Bye.